All right. I don't even have to say be quiet. I appreciate that. All right. Hi again, Scott Jacobson. I'm here with my friend, the co-founder and CEO of Rover, Aaron Easterly. Thank you for being here, Aaron.
Of course.
You know, the theme of, we always have a theme at every annual meeting, and long-term commitments is the theme of this annual meeting. And I can't think of a more impactful long-term commitment than we've had in our partnership together. So thank you for that. That actually deserves. And by the way, for the Fund 4 investors, but also all of the other people in the room, thank you for the incredible exit that you delivered for the fund. That deserves an applause, by the way. So I actually thought it'd be fun to start. We're going to kind of talk about the Rover journey. I thought it'd be fun to start with the founding story, which includes other folks in this room, and sort of how this whole thing came about, including how you got to Rover.
Rover was originally pitched at a startup weekend event by Greg Gottesman, who was a managing director at Madrona at the time. In theory, based on his personal experience with a kennel or a boarding facility, he pitched the idea at a weekend, gave me a call over the weekend. It's like, hey, we're working on this thing. Actually, I think it's kind of interesting. One of the people that joined his team was a college student named Phil Kimmey, who was in between his junior and senior year and was looking to kill time while being home for summer. So Monday comes and Greg's like, hey, we actually won this thing, and you should take a look at this business. And what Greg knew is I was a marketplace expert. He didn't know I was a dog nut. So I was like, I think I can help this business out quite a bit. Over the next several weeks, Phil got going on the tech piece while we looked at the overall business plan. For the next 8 startup weekend events, the same idea was pitched. So we hadn't even launched, didn't even have a pilot, didn't even have a beta, and there was 8 companies that announced they were going to do the exact same thing. So it was a frustrating way to start. Lesson learned: if you're excited about your idea, don't tell the entire world about it before you've built anything.
Nice. And you were hanging out as an EIR at Madrona.
Yeah, I was an EIR at Madrona after leaving Microsoft.
Yeah, cool. So I love Rover's mission to make it possible for everyone to experience the unconditional love of a pet, which is quite broad and I'm sure kind of grew over time. But how did that develop, and then how did you use that to sort of manage the strategy and the priorities of the company?
One of the reasons that Rover really kind of resonated with me personally, I'd worked in digital media for a decade, and I had it was a wonderful decade, but I totally lost interest in it. I was a busy executive. I was not married at the time, and I had a ridiculous 4-pound dog. And business travel was nearly impossible, and it struck me regularly how challenging it is to be a dog lover and live a modern life. And that, we thought that if we could make the logistics of pet care easier, we could actually move the needle on pet ownership. About the same time, Greg was talking with some of the nonprofits in the area, and they mentioned that, concerns around what to do with your dog when you're not home is one of the primary impediments to getting a dog to begin with. So we kind of combined those two things and said, if we're successful, we can actually make it possible for everyone to experience the unconditional love of a pet. Remove all the logistics or the barriers to pet ownership. And our view on it, at least my view, was that there's very few developments, if any, in the history of humankind that have done more to improve human beings' happiness and satisfaction on an ongoing basis than the domestication of dog. People kind of say, oh, that's funny. I'm like, literally name one. It's really hard to name one. And so we thought that we could actually move the needle on human happiness if we were successful, and that became a rallying cry in the company. And it's a lot of how we think about where there are opportunities. So when we take a look at other services or other businesses to go into, of course we do a business plan, but one of the questions we come back to is the lack of a solution in this area an impediment to pet ownership? And there are lots of interesting pet foods in the world, but there's no one in the history of pet ownership that said, you know what, I was going to get a dog, but only if there was an 85th brand of dog food at the grocery store. That has never happened in someone's brain before. So it's a way of us thinking about what's on mission and what's actually going to move the needle with regards to the mission as we look at new opportunities.
So you've had heavily funded competitors over the course of the years. We don't need to name names. What are some of the things you did differently that enabled Rover to win in that context?
Yeah, I guess in the theme of long-term partnerships, one of the things that kind of was unfortunate when we realized really early on at Rover, but was also godsend in some ways, is that there was nothing you could do to have this business become lightning in a bottle or it'd spring up magically overnight. 90% of the people that travel out of town and have pets, they go down the Rolodex of friends, family, neighbors. So they're not even out there looking for a commercial solution. They don't go to Google, they don't go to Yelp, they're not even looking. And then people only travel away from home in the U.S. on average 22, 23 nights a year, but that's kind of biased upwards by business travel. For non-business travel, it's basically a summer vacation of a week and a couple weekend getaways. And so you have a business or an industry that very few people are in market at any period in time for pet care. And 90% of those that are in market don't think of themselves as being in market because they just go down the free solutions of friends, family, neighbors. So it dawned on us very early on that there was no amount of aggression or dollars deployed that would allow you to carve out a sustainable size advantage quickly. And so for us, the obvious point was that it was really going to come down to a long-term unit economics battle. So from day one, we focused on all the drivers of unit economics and worried less about the vanity metrics. Obsessive about how do we improve conversion rates, how do we increase repeat usage, how do we improve customer satisfaction, knowing that the only way to scale this business to be a huge business was eating into that 90% that use friends, family, neighbors. And since they're not looking on Google, the only way to eat into that is through word of mouth. So we had a lot of conviction that marketing dollars did not matter. And that ultimately the marketplace mechanics was what was going to drive long-term competitive advantage. And it gave us a lot of patience. So we wanted to grow fast, but also when competitors announced big funding rounds or big name investors, we just didn't have a lot of anxiety about it. The management team probably had less anxiety than our board, but because we had a strong sense for what mattered and what didn't.
So aligned with that mission, global expansion, you launched Europe in 2018. That was a struggle, if I remember correctly. I think there was a board meeting where we actually talked about potentially shutting it down. And it's now the fastest growing segment of the business. And so, how did you ultimately make that decision and bring the board along to, double down or shut down?
Yeah, I think as a senior leader, one of the things that you have to get very clear on as a CEO is, what is your job? And you could say, hey, you serve at the pleasure of the board of directors, which is true, but does that mean you do what the board wants, or does that mean you operate in the board's interest? And this was one of those times where it was very clear to me that what the right thing for the company over the long term was going to be to sustain the investment. I'd rather get fired for doing something I believed in than do the opposite and then it turning out bad anyway. So there's some difficult conversations on the international front, but we had done our work fundamentally. The dynamics that made Rover work in the U.S. were true in a lot of Northern or Western Europe, maybe more so. a higher proportion of the population lives in metropolitan areas in Europe than in the US. So a peer-to-peer model makes more sense. Tech adoption is the same. Pet as child or pet as family member, meaning the emotional relationship people have with their pets, is generally the same. So we just kind of felt that we had to have patience and just had to not get out over our skis with regards to the fixed cost of the investment, and that it would eventually pay off, and it has.
So fast forward to March of 2020. I remember we had a call where either you or Charlie said that we had negative, or I guess it would have been Tracy at the time, negative bookings, which I didn't know was possible. Yeah. Meaning, the cancellations, this is COVID, right? The cancellations outstrip the new bookings. So that's a metric you'd like to not see.
Yeah, I didn't know it was possible either.
Yeah. And you had some pretty tough decisions to make. We 40% of the headcount, 50% of the OpEx, and a lot of lack of clarity. I think it would just be helpful to kind of talk about some of the challenges, how you made some of those decisions, guided the company through that very tough patch.
Step one, take a deep breath. This is one of those times where having a good set of investors on the board and just on the cap table in general is helpful. Kind of steady and calming influence. We had negative sales, and it's not just kind of like, okay, that's awful, that's negative sales, but we had already collected the dollars for all those bookings that got canceled. So a huge chunk of cash in our bank accounts disappeared overnight. And so we quickly decided that we weren't going to be able to predict the course of the pandemic, so we did scenario planning, like at what level of cost reduction and at what level of revenue gives us what level of runway, and kind of did the 2x2 or maybe 5x5, but the 2 dimensions, and then kind of got to levels like, okay, like we think we can last 24 months if we cut to this point, and 36 months, including our debt line. But one, in the downside case, we want at least a year, plus maybe another 12 months with the debt. So it's just a matter of trying to get to the comfort around the runway piece. For the employees piece, that was harder. We, partly because we thought that there was no lightning in a bottle in this business, like we were always financially disciplined. And one of the things that was really hard about that is, unlike a lot of startups who, mentality is sometimes go for broke, $1 billion or bust. We had always had good unit economics. We had always made thoughtful investment decisions. And so we had always managed the business that, like, we thought would, if the business had a real value proposition, that we would never be in a position where we would have to do a layoff because we never got out over our skis. And it turns out we were wrong, and that was hard. For our employees, the toughest thing about going through a large reduction in force is and the moment where you have to tell people that they're not going to be part of the company going forward, that's hard. But the harder thing when you look at the cumulative impact is those that remain, and how do they feel about themselves? How do they feel about being one of the survivors? How do they feel about the prospects? And you can do certain things to make that better, but you just got to let people emote and be where they're at to some degree. Ideally, you cut once, cut deep, so you don't have to kind of have the axe keep falling over time. We did that. We presented to our employees at the time. We went through and said, hey, like, this is hard. There are tough decisions to make, but here's why we think we're going to come out the other side of this better off. And this was like right when the pandemic hit. We said, hey, we think, given that logistics of care is one of the barriers to pet adoption, we think there's going to be a spike in pet ownership. We think that a lot of our competitors are going to go out of business. We think that people's emotional relationship with their pets is going to be deepened by being at home with them all the time. So we think we're going to come out of this with larger market share and a bigger addressable market to go after. The majority of our employees didn't believe us at that point. There was more of a, whatever, I don't believe this. But it played out remarkably similar to how we thought it would. With maybe the exception of not as many people went out of business, particularly in Europe, as we thought, because some of the subsidies for keeping businesses afloat in the pandemic. But it played out remarkably similar to how we thought it would, and the recovery was actually a lot faster than we thought it would.
Yeah, and that there was definitely a puppy pandemic. We were a recipient of a lovely little Cavapoo, and the mental health point definitely resonates, as I'm sure it does with many people in the room. And that was a boon to the business, right? And the benefit of a lower cost structure meant you actually had a real path to profitability and a nice growth rate. And at that point, we decided to enter the public markets. We did that, as this group heard earlier, via Spac. Maybe just talk a little bit about that, the thought process around that, the decision. If you had to do it over again, would you do it any differently?
Yeah, it was for those that aren't local, you probably don't know Rover's reputation, but Rover is known for being, in addition to just very honest and candid, also very analytical. Like, logic drives everything, no emotions. And so we took the same approach to the decision on how to go public or whether or not to even go public. Our goal was we wanted to raise $100 million so that we could invest into the recovery, and we didn't want to have to be as concerned around runway as we were during the pandemic. And so the options are you can do a private mezzanine round, late stage growth equity round, you can go public traditional way, or you can go public via SPAC. And we were looking at the private fundraise, and one of the things that we've always had is a very clean cap table. So 1X, non-participating preferences, blended, so there's no stacked. Everyone's kind of in the same boat. No one had blocking rights. No one had control rights. And so there was a very low likelihood that we could have secured a mezzanine round that didn't screw up the control dynamics of the company. And we thought that given a big chunk of our investors had been on the cap table close to a decade, we'd be back going public a year later anyway. So we said, that's just dumb. Let's just do this once. And then on the SPAC versus traditional IPO, Morgan Stanley actually advised us to do the traditional IPO. But for us, it was insurance. And the SPAC process offered a couple things that the traditional IPO didn't. Namely, you set the price and the terms, and if you raise a pipe up front and you have a sponsor that backstops the deal, you basically have a guaranteed fundraise one day into the process. IPO, you get all the way at the end of the process, and you still don't know how much money you're going to raise, depending upon market conditions the night before you go. You also don't know what the price is going to be, based on market conditions the night before you go. So the SPAC process allowed us to determine the price and a minimum fundraise one day into the process versus waiting to 6 or 9 months later to figure that out. The other dynamic is our business was ravaged during the pandemic. And we're like, if you chart, the annual numbers, there's a massive dip, in the year prior. And so how the hell do you message that story unless you're willing to get into the assumptions around the forward-looking financials? So the SPAC process allowed you to share your forward-looking financials and the assumptions behind them. And unlike a lot of companies that went SPAC, it wasn't pie in the sky stuff. It was, no, this is simple cohort stuff. These are the assumptions. And we thought the ability to actually educate investors in a way that we could not have done with the traditional IPO process was vital, given we were one of the tech businesses that was absolutely ravaged by the pandemic. So for those two reasons, we kind of viewed going the SPAC route as insurance to our ultimate goal of, hey, how do we maximize the probability we get through this process with at least $100 million on the other side? And our logic, I think, was sound, well-reasoned. We knew that there was likely going to be some type of SPAC hangover because of the sheer amount of low-quality companies that were using that vehicle at the time. but we figured, over the long term, it's whether or not you can perform anyways, and the worst outcome would have been getting all the way to the end of the process and having to yank an IPO.
And I think I can say comfortably that you actually enjoyed being a public company CEO, which not everybody does.
Yeah, a lot of startup CEOs, if they get the opportunity to go public, like 95% of them instantly transition to how much they hate public company life. Like, oh, this quarterly thing, no one cares about the mission, everyone is short-term focused, it's so distracting, there's these expectations game. And I would say, for me, I was kind of indifferent, but I would say the experience of being a public company CEO was so much better than I would have thought it was based on what people said. Like, if you get really organized around your legal stuff and your finance team, most of the burden is actually done by those groups if you have the right people in the right roles. And our legal and finance teams were phenomenal. And then so much of the market goes up and down, things are in favor and out of favor. But we also had a philosophy that's like we were going to be ultra transparent around the assumptions, what we know, what we don't know. We shared more data than most. We always said like it was, and we're transparent around, hey, what like things that weren't working like we wanted it to work in our business. And so for people that sell the sizzle, and all of a sudden the stove gets turned off, there ain't any sizzle anymore, and it's you have like a reckoning. But we were never sell the sizzle people. We were kind of sell the reality. And so even with the ups and downs in the market, there wasn't a lot we had to do differently because we never intended to try and take advantage of the irrational portion of the market to begin with.
So you did end at least the first public leg of your journey.
Yeah, who knows?
A few years from now, we might see it back again. But so that was a process and a decision, and ultimately, you and the board together decided to sell the company to Blackstone. Maybe just talk a little bit about the process and at least wearing your CEO and board member hat, how you approached it.
Again, going back to the pathologically honest and very data-oriented, as a management team, we've always just been guided by like, what's the right decision, not what are our preferences. And we approached it the same way. So we had our 5 to 10 year financial plan, and we, unlike a lot of people, we worked really hard to have that be as accurately as we thought humanly possible, as accurate as humanly possible. It wasn't an aspirational plan. It was what we thought would happen, and that gave us a lot of confidence to know what the alternatives would look like. Talking with our attorneys is hilarious because, I guess the norm when you create long-term financial plans is to intersperse a lot of management optimism in that. Our view was, if you create a plan that's BS, then how do you decide whether or not it's an offer you should take? Because you got, is it 20% BS or 50% BS or 80% BS? You just don't know. And so we approached it very matter of fact, but then included some of the things that we're going to be doing this year and in the future that's more speculative, but how do we place a value on those things? And so that, and we eventually did all the math and got to a number. It's if they can get to this number, it's the right decision. And so they got to that number, after they had submitted multiple offers, of which we didn't respond to. We kindly said, thank you. We appreciate your interest in the company, and it'll be nice to chat at some later point in time. But it gave us a lot of conviction to what may have been viewed as a very bold or aggressive negotiating tactic. It was actually driven 100% by the math. And so, and it was easier for our team to accept the decision too, because it was very clear that it wasn't being driven by CEO preference or board preference or anything else. It was just being driven by like, hey, like the deal makes sense to take. I think Rover will be and can be a successful company if it's public, can be a successful company if it's private, it can be a successful division of some other strategic. Like it's a really good business, and the cap table structure shouldn't matter that much. We think we can be successful whatever the ownership structure looks like.
Well, to that point, you're a few weeks into being owned by, a cap table with a, party of one outside of the management team. And it's probably early
Party of two.
Probably early to judge, but anything you anticipate changing, in the way you execute strategy otherwise in this new ownership structure?
Yeah, I think so. I think one of the funny things you and I were chatting about before the session started is, private equity, especially Blackstone, like they have an intended hold period. So it's a lot longer than public market investors, but it's not forever. And when you do financial planning with a lens towards over what horizon, it greatly simplifies decisions. As a public company, you want to maximize long-term value, but you kind of have to explain every point along the process. You have to explain how that makes sense. As a private company, it's a little bit easier to say, this thing will make sense in 5 years, and no one has to know about it between now and then. And so, as an example, that there are markets in Europe that we would love to enter, but like those things aren't going to get profitable for 5 years. Now it's not a huge amount of burn in the meantime, but like it's not going to be accretive for quite a while. So an investment like that is a little bit easier to wrap your mind around and do the scenario planning on it and look at the returns on it as a private company than it is as a public company.
Mm-hmm. Well, this, a lot of today is talking about technology, and the technology is coming down the pike. You're a now 13-ish-year-old company. Are there technologies, as you think forward in the next 5 years of Rover that you're particularly excited about, new technologies and ways to apply them?
Yeah, I think everyone's obviously keeping an eye on the generative AI piece. I think that will be transformational for a lot of businesses. I think it's less transformational for Rover, but can greatly improve how we do certain things. I think there's an opportunity to have more immediate, tailored support and customer care with that tech. I think for people that are weird pet owners, and I say that with all the love in the world, pet parents as a group were particular, and finding the exact right match for a dog that may have some issues. Like you can achieve that on Rover today, but you gotta use the custom filters, the advanced search, and apply a lot of logic. Like it would be nice if we could figure out how to translate conversational speak in terms of what someone is looking for in their pet sitter into the exact right match without someone having to figure out a bunch of Boolean variables and drop-down boxes and radio buttons. So we think that we can probably improve our matching and our search capabilities as well. With all scale marketplaces that are peer-to-peer in nature, one of the sad realities is once you get to a certain size, you're a target for bad actors. So I think the technology to identify weird behavioral patterns early before people can try and commit fraud or whatever will be helpful as well. So we're 13 years in, but like we're still just getting started. I think going forward, we plan to address more of the existing commercial market. We're excited about that, but it will involve a totally different muscle group than we have built to date. And we think this business was always going to be a 20 to 30-year journey, but the next 10 is likely to be as interesting as the prior.
Excellent. Well, that's a great note for us to end on. I can say on behalf of the entire Madrona team just how meaningful and grateful we are for the partnership over the long term, and thanks for spending some time with us today.
Can I make one other comment? One other thing I just thought I'd say, it has been a privilege to have people's long-term oriented as our investor base. When we exit or we agreed to sell, something like 30% of the cap table belonged to people who had been in the company 10 years or more. And that's not a privilege that a lot of people have. The funny thing about it is I think that if you went around the board, I don't think I'm supposed to disclose this stuff, but by far and away the people most hesitant to sell or had the biggest price in their mind was our early stage investors, particularly Madrona. And you know, sometimes I'm told that CEOs can feel pressure to sell when you know, a lot of your investors need to get out of the stock. And I'd say the decisions by Madrona at every point in the way has been in the best interest of shareholders, and there was none of that. And just it was really neat. One of the things I'm looking forward to about the next stage is there's something really special about having long-term investors. Hopefully we have a good set in this next stage, but we're fortunate to have the ones we had.
Thank you. Okay, now Soma.